I'm your host today, and we are joined by 4 panelists who I'm sure you will all know very well for the first event in a series by Callsign and Outward VC called the FinTech Forecast. It's going to be an annual event bringing together leading figures in FinTech to discuss the state of the market. And today we'll be discussing FinTech winners in a post-COVID world. So of course, the discussion about winners and losers has been on our minds perhaps since we first learned the pandemic had reached Europe, and we basically wanted to mesh out what winning actually means in this new world. Have the goalposts changed? Have expectations changed? Eileen, I want to come to you first on that question, and how you're managing to adjust to this changing world.
Sure. Thanks very much, Isabel, and thanks to everyone for having me on the panel today. Yeah, I don't think actually the goalposts have changed as such. I think they might have moved a little bit further away, if I were to think about that metaphor, at least for FinTech, because I don't think there's going to be radical change in terms of what success means for FinTech companies. All of the FinTech companies certainly that we've worked with at Passion, but also the ones I have exposure to on the treasury side, everyone's looking at providing, genuine value and utility for how either customers, consumers, or, companies are accessing financial markets, financial services, and having to do with payments. So in that sense, I don't think that changes drastically post-COVID. Whether or not a company is therefore successful at achieving that, though, is clearly going to take longer. And when I think about the effects on FinTech, depending on whether you're looking at a business-to-business situation or business-to-consumer, on the B2B side, we're actually not seeing with our portfolio a dramatic impact on revenue, for example, or growth. But on the retail side, absolutely impact, right? Because of everyone being in a lockdown situation. So you might therefore argue that the B2B side is just going to see the effects slightly later. But I think therefore you're going to have a few months where it looks like the world in terms of successful outcomes for FinTechs, we're slightly paused. I don't think it changes dramatically. I don't think it shifts. I don't think it alters what FinTech companies set out to achieve or are going to try to achieve or deliver for their customers. I think it's just going to take a little bit longer. And part of the first milestone with COVID, I think, will be to make sure there's enough runway to get on the other side.
Thank you. I want to come to Devin next. Devin is the co-head of Outward VC by way of introduction. I think when we talked initially, you think that perhaps especially on the retail side of things, that success and this idea of success might well be moving, as Eileen said, at least moving back. But actually, we also need to think about survival, perhaps, for the first time. I mean, founders always think about survival, but more pressing than ever. What are your thoughts on this and how we conceptualize winning in this new state?
Yeah, I'd agree with Eileen to an extent that success has, or that winning has, is time-based. So there's a short-term issue about survival for many, particularly on the B2C side, and there's a long-term issue around winning in general. But I think that the bigger thing, is, to me, about who you're selling or what your market is. And in this situation that we're in with COVID, it's about staying relevant. So if you're on the consumer side, how do you stay relevant to your customers and your clients? On the B2B side, it's about how do you stay relevant to enterprise and procurement in enterprise when they're so busy with the loan schemes and other areas so if you're a smaller accounting software B2B business, how are you going to get the bandwidth? How are you going to get the time to sell into? So that will puts enormous pressure on you as a small FinTech or even as a growth FinTech to adapt and survive during this period. So I do think the goalposts of winning to some extent have changed. I think in the short term, it's about survival, because if you've survived, you've arguably won, because I would look at it in a sports metaphor that, you're 1-0, sadly, COVID has made us 1-0 down in many instances. And if you come back to a 1-1 draw in the last minute, that's arguably a win, because you managed to survive where many others, particularly on the smaller end, will struggle, as Eileen mentioned, because of runway.
I love that you managed to squeeze football in there. Sasha from Curve, I wanted to come to you. Obviously, the market does look different. You are obviously playing in the retail side here. It's unclear actually if the market has shrunk for retail, either over the top banks as you are or challenger banks. How does the market look now? Can you tell us a little bit about what your customers are doing and how that translates in the short term for how you measure success?
Of course. So the kind of connecting the previous question to this one, which is would be a very nice connection, would be that what winning means is the same. You have to achieve your mission, and for most of us on B2C, it's around traction, and traction is around scaling of customer base and scaling of revenues and contribution margin, unit economics, and that kind of remain the same. It's just harder. It's harder to achieve it right now, and that's why is it harder? Because people are locked at home in most of European countries, and that means there's less social engagement. And the best products are growing very much because of viral growth. People talking with people, meeting with people, socializing, buying lunch to each other at the workplace or outside, and that has decreased. Therefore, it means the impact has been on growth for most companies, including Curve, not significantly, but has been an impact on the referral or the social engagement. The second thing, which we're very happy with the result for Curve, but we're aware it has a larger impact in the market, is that people are spending less money. Number one, because they have less opportunity to spend money, but they also are more concerned because of the unknowns of their job security, or even just they can't travel. So we've seen a decrease in GTV, and most of the fintechs in the market, which are B2C, GTV, gross transaction value or volume, has decreased. What we've seen in the market from our partners that have cross market numbers, processor network like MasterCard, we've seen around 50 to 60% reduction in GTV across all fintechs. This is very impactful. It basically means the revenue basically cut up by 50%. And it's even worse to companies that are doing travel-related fintechs that are seeing up to 70-80% reduction in spend, which is hugely impactful on their plans. With Curve, the beauty here is, and a lot of investors in the market is looking at different fintechs to see how resilient are they during COVID. We're only seeing around 20 to 25% reduction in GTV. And the reason is because Curve is very much your everyday card spend. We're not asking you to use it only for one use case. And it's also more secure to use it online. So people just transformed and changed their spend from offline with a physical card to online.
So,
and with Curve,
if I can just stop you there, just to kind of condense what we're hearing here, it's that, so basically the number one variable to get through this will of course be the survival element, which ultimately comes to the cash element. Yeah. So whether or not you're seeing numbers change now in the short term, ultimately it's about getting over this hurdle, and that will probably come down to how much money you have in the bank. So then the next question is, if we all agree that we still want to get to X, and as you're saying, Curve still has the same mission to get there, and hopefully has the runway to do that. The next question is, has the direction in which you choose to get there changed? Amir, I want to come to you, Amir from Callsign. Essentially, if we want to use the metaphor, we've used football, we can use the metaphor now of cars. It's about choosing the right car, the right method to get there. You know, there you can use a race car or a city car, and then what I'm interested in is if there is now discussions about modifying the journey in which you guys have been on, and the path to get to where you 2 months ago wanted to be.
Yeah, look, it's a great question. I think actually all the previous panelists have set the scene perfectly as well. If anything, what I'll do is just give a bit of wraparound of why they're saying what they're saying. So Eileen spoke about as long as you're doing something essential, you're going to be fine. And her portfolio companies are in that space. I think the reason why that statement is true is we're going through a crisis, and for me, as someone who worked in a bank during the global financial crisis, and someone who was in Silicon Valley during the .com bust, this is probably going to be worse than both of them. And as a result, we're going to see consumers who have less spend. They're going to be focusing on essentials rather than nice to have. So, you know, Shahaz mentioned about travel spend, that kind of thing. Even when the travel ban is lifted, I'm not sure we're going to see the same levels of travel we saw before. If you then look at it from an enterprise perspective. What that means is they're, like Shahar said, they're getting less volume, less transactions, income coming in. So they're going to focus only on spending and buying from B2B, like Callsign, if it's either an essential service or a revenue increasing service. So I think that's a shift we're going to see. And the losers will be people who aren't essential. Like if you have a startup doing like a luxury good, I don't think startup luxury is going to do very well in the next few years, as an example. So if I take that reasoning that the panelists kind of describe incredibly well in terms of you have to be essential or revenue, and apply that to Callsign, we always think about we're in the authentication space. What does the world look like at the moment? Where is the world going to move towards? And if I use the metaphor of, let's say, consumer behavior, because we're selling to banking brands or retail brands and service consumers. Consumers are now operating in an omni-channel world. So they've got mobile, they've got desktop, laptop, they've got tablets, and they want the brand to be a retailer or bank that they interact with to recognize them and be able to naturally transport across that. The obvious one that everyone can relate to is Spotify and Netflix, right? You want your Netflix movie, you're watching on your TV to transfer it to your tablet, you want your playlist to Spotify to transfer. People are going to want to see their banks operating in the same way. And so what we're thinking about, what are the digital channels? The digital channels for us are not just mobile and web, but there's also what we call the card not present journey, which is the third digital channel, which is a bank-issued card being spent virtually online, right? So in the Monzo case, Monzo has a brilliant app, and everyone will say Monzo's functionality is fantastic. If you look at it just on business banking, that's a great web experience because business banking requires web. What they can't control as well is the card not present journey. But that is part of the overall experience that someone has when they bank with Monzo. That's why I think Shahar is making great kind of runway in the space he's got with an OTT card, is that card not present journey. So very, very long story I've set you. In terms of how that applies to Callsign, we are ensuring that the narrative that we are telling our potential partners is that we're a solution designed for that omnichannel world. So we handle all three of those digital journeys, and we let you manage them all as a single software instance, so you don't have to have lots of siloed architecture. And then the other piece of it is we're a multi-tenant SaaS. So if you want to go into new regions, if Monzo wants to launch in the US, if Curve wants to launch in the US, again, our software will handle that. So it's a multi-tenant, it's an omni-channel solution, and we believe it's an essential one. It's one that's in dire need of upgrading. So I don't think we've necessarily got a new car, if I use your kind of racing analogy. What we've done is we've ensured that what is the right car for the current climate? We believe it's like an all-terrain, an SUV type car, and we're making sure that our platform does that, and also that narrative explains that we do that as well.
Isabel, can I just on that point? I don't know if it's the car, sticking to the car analogy. I think that winning also, it's not about what car you have, it's about what race you're in. And in some instances in FinTech, there is no anyone else in the race because you've created a whole new category, right? And I think, therefore, it doesn't matter what car you drive, you've got a much easier race than if you're trying to build, say, a very competitive race, which may be another bank, for example, or a neobank split race is very competitive. So really, I think it really depends on the race you're in. And I think what we're seeing now is areas which are historically new categories emerging where there's no other peer. We'll see them come to prominence very quickly.
And maybe picking up on this point and connecting to your initial point direction, startups are operating on 5 to 10 years horizons, as do their VCs. So the COVID situation where the economy is in coma is temporarily, it's painful. It feels to us a long time. It's over a year, maybe 18 months, but it's temporarily at a horizon of 10 years. So companies that emerged, startups that emerged 4 or 5 years ago, like Curve, Revolut, Monzo, we all had a certain direction we set. Monzo wants to build a better bank. Curve wants to rebundle FinTech, finance. Now, I know that many other companies today are talking about the same inevitable end game of rebundling finance into one app, one interface, Spotify for money if you'd like. But this is where I think what Devin and Amir mentioned around the car and race analogy. If you are in a Formula One race rebundling money, make sure you're coming in with a Ferrari and not a Ford. That's, I think, the analogy is.
Are you talking
And if you're gonna pivot, sorry.
In terms of the Ferrari, how do you create that though? Is that the tech?
The Ferrari is not just the wheels and the engine behind it. It's the entire machine. It's those small different experiences and structures that make it drive faster. It's the aerodynamics of that. It's the thought process around how the driver sits and how the pedals are close to each other or not, and the type of shift gear they're using.
So
it's not just one thing.
In the FinTech setting though, does that translate to the company leadership, or is that the tech side, or is that?
It's everything, but it starts with a mission. What's the mission? I'm building a car to win Formula One, or I'm building a car to have a city drive. That's the mission. And then everything else drives from that. If you start building a car for city drive, i.e. a bank, it's going to be very unlikely that this same car can go and pivot to become a Formula One car.
Yeah, I want to come to Aline next on this then, because if we're talking about what's essential, if you guys have identified that being essential is essentially what will get some of these companies through this, hasn't what is essential just changed for the consumer at least? You know, let's say Monzo wanted to create a premium product around travel insurance, or indeed Curve has its premium card, most of which is geared towards travel perks, right? I mean, that doesn't exist anymore. So what method do we use now to either keep in the race, or do we just drop out of that race temporarily?
Yeah, so I think it's going to depend for the company and what they were wanting to achieve in the first place. Monzo's mission has always been about making money work for everyone. And so it wasn't just, focused at specific niches or offers or things like that. It was coming from a point of view of offering the best current accounts in the UK, for example. And so to your point, if a pandemic or a downturn forces everyone to rethink priorities, that doesn't mean certainly a company like Monzo or the other ones that we've been talking about today should drop out of the race. It does, I think, make people reconsider if they started doing different things, and also to address whether they have been achieving their original mission or their core mission successfully enough. And so for Monzo, it's a great opportunity, right? It's always been really minded, for example, on financial inclusion. It's always been minded about accessibility, ease of use, about making sure that people had access to their best budgeting tools and to their money in pots or however they wanted to use them and categorize them. That's more important than ever. There's a reason why actually, execs of retail banks are categorized as key workers by the government. And so that's not actually dissipating in need. And there's an opportunity to reinforce why Monzo or other challengers or other types of companies are offering these better than either incumbents or other competitors in the market.
But I guess obviously that needs to translate into some form of revenue stream. So although it does what it does very well, the likes, these retail facing companies are going to have to say, we do this very well, but how do we create basically money out of this, right?
Sure, but I would argue that's not COVID specific either. It probably brings it into frame. It certainly brings it into focus when you look at, as was already previously mentioned on the Curve side, for example, if people are making fewer transactions, that probably translates to lower interchange fees, and that therefore directly translates into revenue. But revenue has always got to be a driver, and maybe when we were talking about goalposts, we were talking about runway and why revenue is important. And that's got to be to the sustainability of the business, 100%. And so yes, all fintechs, whether they're in retail banking, whether they're in financial services, or what level of financial services, have to really go back to basics and make sure that they're operating under a business model that's got viability and sustainability, no question about it.
And I think just to add to Eileen's point, I think for the well-funded fintechs, it's about remaining very, very focused. They rather now, I think there's going to be a change from going wider to going deeper. And the deeper is where you keep your engagement, we live in a world of, as we know, of instant gratification, where we expect things done exceptionally quickly. So, whether it's thinking about read-write access, which I know Curve's built into its platform, and frictionless credit and pieces like that, that's where they're going to go, rather than looking at travel, looking at other areas to bolt on into. And for the less funded fintechs, I think it's just, again, trying to stay relevant. And that's where I think, going back to the original question about funding, they come to a crunch point, because revenue is much tighter for a B2C business, right?
Yeah, I guess my overall thinking was, does the way you make money now change for some of these fintechs? But I guess that will be a question that if they have the runway, I guess the answer is it's fine either way, right? They have the time to kill. I wanted to move on, which is more about how you incentivize the founders at this very difficult time to keep pushing that race car along the track. I think the psychology of leaders at this time is particularly interesting. I think Devin and Eileen, you are probably the best people here to speak about how VCs can do that and the mechanisms perhaps that you're introducing, perhaps for the first time in recent years, to ensure that that happens. I don't know if that's a concern or something that you guys are thinking of. Maybe Devin, if I can come to you first.
Yeah, I think that incentivizing founders is always important, even more so during a crisis. But I would say that leaders are forged in a crisis, and I think this is where they really come to the fore. And there's a very big difference between a manager and a leader. And I think a leader is someone who now realizes the situation, the vision hasn't changed, but we need to maybe pivot certain elements of the strategy to attain the vision. So how do you incentivize them? I think it's also where their starting point is. A founder with 20% of the equity or 25% of the equity is very different to a founder with 6 or 7% of the equity. So, but it's not just about money. It shouldn't be about money. The founders that you back it's not just about ensuring that they, at the end of the day, when they've got a big bank balance, it's about actually what a lot of them are rightfully motivated by what they're building. So to ensure what we have looked at and what we are exploring with some of our is looking at performance related option schemes over the next few years, see how that they can, readjusting them to ensure that if they get through the crisis that they manage to do that in a very positive manner, that they can be rewarded accordingly.
And performance related option schemes new, or have they been adjusted?
They've been our performance option schemes can be adjusted at any time, but they've been in place for donkey's years. It's about the question of maybe recalibrating them, because clearly the expectations of what's happened from a macro perspective are completely different to what they were 3-4 months ago.
Making sure that those performance plans are attainable then. Natasha, you're a founder, you seem pretty incentivized already. But I mean, it is a realistic question to say, if I'm going to be busting my guts over the next few months and years and trying to get your team to do the same, I guess if you're approaching a fundraise, which I understand you are, these are questions that do come up. So maybe you can share your thoughts again as a founder there.
So there is a huge difference if you own 25-30% of the company to 5%.
Right.
That's number one. And the real difference is less about, you should then not worry about whether the founder is incentivized enough. You should worry enough as a shareholder. I would worry, is the company has the right leadership and an alignment of incentive between shareholders to the leadership. Because it's more like a professional CEO becomes with remuneration. And that's where shareholders likely to say, okay, I want to increase your equity with certain milestones. But in general, and I'm not trying to generalize anyone, I'm telling what I think about founders. I like to compare founders to rock stars. We're coming with a mission that we want to be known. We want to make a dent. We actually really want to be known, whether it's because we want to be known because we have this egocentric, I want to be known as a rock star, or I actually want to make a difference in the world. And I think if we take all the founders that here in FinTech, or any other founder like Elon Musk and anywhere else, they are very much like rock star. They want to be known, and that's a huge driver. The idea of the shares, the equity, is just really to ensure that there's alignment between the shareholders to the management of the company. And this is where you see a lot of professional CEOs get a lot of equity stake. And I think the Microsoft or Google CEOs and the equity stake they got when they joined to become CEOs in the past years is a good example of that. The equity stake is significant to ensure alignment of interest between shareholders to the management.
I mean, rock stars are obviously also famously divas. Eileen, have you seen any diva-ish behavior in the last few weeks, particularly, I guess, if you're in fundraising mode or in fundraising discussions? I mean, I say that's tongue in cheek, but I guess it is something that you might be seeing.
I don't think in the last few weeks. I think if there were divas in the sector, and I don't know that there are, by the way, relative to any other sector, I don't think that's the case. But I would say, the pandemic has probably tempered anybody's kind of diva-esque traits or impulses. I mean, it's been humbling, obviously, right? Even as consumers ourselves, or people who are now all remote working and helping our families to cope and for everyone adjust. So I don't really think I've seen founders behaving like divas or in any kind of a demanding way at all. And as has already been said, I think founders, the best leaders, they absolutely embrace challenge.
Mm-hmm.
It's really important and part of their DNA to demonstrate or to prove that they can achieve something that maybe most people would find really difficult or hard to achieve. And so I think you'll see a lot of people rising to that challenge, and it's a really great opportunity therefore to really see who's going to emerge as the top talent in the UK or in FinTech more broadly.
Mm-hmm.
Yeah, Isabel.
Yeah,
to add to what everyone said there, to describe myself in crude terms, I'm effectively a hired executive, right? And one thing I would say is when you are looking for your next role, you're not just looking at the company, you're looking at the founder. Because as Shahar has kind of alluded to, the founder is the front man or front woman of the rock band, and therefore they're setting the culture, they're setting the pace of how the company's working, not just the vision, the kind of external vision of where we want to get to, but the internal mechanics of how the company works. So it's very important that you believe in the founder and like them and want to work with them, not just even the product. And I would like to work for this company or this brand. And as someone who started their career working in companies that were run by executives as opposed to founders, you can massively notice the difference in terms of how a company, in terms of the pace, in terms of the unwillingness to settle for something, whether it's mediocrity or the wrong answer. It doesn't matter how difficult it is, a founder will generally want to solve it, while an executive is more concerned about their career and their pension and the next promotion. So I think that's something that's incredibly important from someone from the outside who isn't a VC or a founder on this panel. And I think that's something that everyone who's looking for a role should think about.
And I think the best rock stars, which is using the rock star analogy, the best rock star or founders want to share the stage. I think they want to share the stage with their team and with, and I think that as they grow, they kind of put themselves out of a job each time in a way, like a different area. And that's and I think that's what they should be doing. And the best ones do, in our experience.
And then that's the question you ask yourself, right? When you're looking at your next role, you ask yourself, are they really going to let me do my role? Or are they hiring someone in name, but they're still going to want to interfere and micromanage every detail of it? And what you find is the experienced founders, the successful founders, are willing to hire talent and delegate, and have an all-star rock group, as opposed to just the front man and everyone else is giving lines.
Have the demands on you been heavier in the last few weeks, Amir? Just as I guess as you talk about the founders trying to motivate as well, how have you found the demand change?
No, I don't think the demand has changed. I think I'm lucky enough that I've worked for the last couple of years for a number of very good founders who set the right pace, who rally the troops and make them aware that yes, outside it is depressing. We're concerned about our family members, we're worried about the economy. There's a lot of things that could distract us. And if you read the news, you think it's bad for companies. But again, as someone who worked through the dot-com bust and the GFC, actually, you get more long-term gain during this kind of period than you would during a boom period. That's the kind of message we're trying to get through to people is companies will drop off, competitors will drop off. There'll be opportunities to hire top talent that we previously couldn't get, or actually acquisitions of firms. So there's a lot of opportunity right now, as kind of bad as that sounds to talk about. And so you don't this period hoping you survive. You're planning and waiting for that cycle change because you're going to thrive when the boom comes back.
Yeah, I think talent and in that respect of winning also plays in here. On the theme of leaders and founders and leaders being born at difficult times, it would obviously be amiss of us not to mention the change of leadership at Monzo. It is a difficult time, and I guess the decision has been made that Tom will be better placed in a different role as president. Eileen, obviously you're close to that company. I want to give you the opportunity to share your thoughts on that change of leadership And I mean, particularly at this time.
Sure, happy to. I do think it's maybe conflating two different things, though, because of the timing, to actually relate it to COVID or most of what we're talking about on the panel, just for whatever it's worth. These kinds of changes or decisions don't, just happen overnight or even in the span of 5 or 6 weeks. So it's been something, that at a board level and certainly between Tom and the chair, Gary Hoffman, and investors that we've been debating about and talking about for quite some time. And now that the change has been announced, I look back in hindsight and I think we probably should have done this maybe a year or more ago. Yeah, it's something that, looking at it, and actually I think Isabel, one of your colleagues, wrote an article or wrote a piece that I saw either this morning or last night, for example, talking about it and comparing or contrasting the situation to peers or to others in the tech sector or even in FinTech. And I remember thinking actually
that it was kind of unprecedented for a unicorn FinTech as we know it to have done this.
Yeah, so actually, and I remember reading that and thinking, I actually think that was an interesting context. And I think it's Devin who was talking about what race you're in. And so I guess the race that was being described there was unicorn FinTechs. I think it's really important to just be cognizant, Monzo is a regulated bank. And so, yes, we think of it as a FinTech unicorn. I think of it as a high, growth tech company. We all look at it in that light, but it's a regulated bank. It's, got more than 4.2 million customers, over £1.5 billion in deposits. It was the #1 bank for current account switching services in Q4 2019. I think it's a top 8 UK bank now out of 300 banks in the UK. So it is part of the UK banking infrastructure and a systemic sort of point of relevance there. That means that the regulatory burden or oversight for customer outcomes, and for good reason, right, but is really, really strong. And I think that's very different than maybe non-regulated banking FinTech unicorns and certainly standard tech companies. And that's really what drove that change, which is why I look back and think we probably should have done that even longer ago, because, as an investor and an early investor, when we backed the company in the first place, did we hope that Tom would spend 90% of his time thinking about, global strategy, internationalization, customer propositions, product, marketing and customer engagement? Or did we think he would spend 90% of his time talking to regulators? And over the last year or so, it's clearly been the latter. That's not, in my opinion, the best use of his time. And fair play to him, he was the first person to say some months ago, I would really rather be spending my time on the things that I've done for the first, few years of this bank and building this company. He doesn't, he said even the company itself, not the bank. And we should have somebody else really being the interface for the regulators and thinking about how we continue to become, more and more important in the kind of banking infrastructure here in the UK. But I want to go back to thinking about, really what are we doing as a bank? How are we pushing the envelope? Where do we come up with more innovation like gambling block, like savings pots, like get paid early? How do I get back to thinking about propositions? So that's what precipitated that change. And I think we've been talking about leaders versus founders. Don't see any diminishing, of Tom's leadership role in the company. Quite the opposite, right? I think this is going to reignite and re-amplify, I think, that, the kind of role as a cultural keeper and the vision for the business. And it allows him really the freedom to do that without having to respond to 150 regulatory requests a year, for example. So for us, that's the kind of thinking behind it. And it's of course during COVID, but it wasn't driven by COVID at all. These things don't kind of happen just because of a few weeks.
Yeah, of course.
I actually have a founder view of that. I think
Sure.
the journalism is focused on the wrong thing. Tom is leaving as a CEO, moving elsewhere. I know it catches the headlines, but I don't think it's the right thing to do. Tom is a great guy, one of the best product people I've met in my life. Really smart. And I too would like to go back into product. Trust me, every morning I want to do UX design. I want to do proposition. That's not my job. My job is to make sure I'm building a strong leadership team that can delegate authority and scale the company up to become a worldwide conglomerate. And the concern I see as a shareholder, if I was a shareholder of Monzo, is actually different. Is having the founder moving away from the CEO job because of and putting an executive, a salaried executive as the CEO, because it became a bank tells me actually quite worrying stuff. Monzo put on a flag, I want to create a financial control center for your money. I.e., I want to race in a Formula One car and I want to rebundle money. But at the same time, they're becoming a more bank. If they become a bank, it means they're competing with all other banks and issuers, which means they cannot create a marketplace. So the vision of, if that was indeed the vision of Monzo, is being lost right now in exchange of becoming a bank. Add to that the fact that CEOs, salaried CEOs, are looking at 2 to 4, 5 years horizons, because if they won't give you results in the next 2 years, short-term results, they might be fired. Founders, I don't give a fuck about, well, of course I do, and I'm sorry for the language, but I care less about the next 2 years. I care more about the next 7 years or 8 years, because I'm a shareholder. I'm looking at long-term value, which tells me another concern that actually Monzo will do things in the short term that will impact their strategic claimed view of financial control for your money. And also, in my view, if I go to my board and tell them, guys, I really like to do product, do me a favor, get the CEO instead of me, this is me, in my view, disappointing my shareholders, because they not only invested in Curve because they thought I'd be able to big the company to 2, 3, 4 million customers. They invested in Curve because they thought the founder can be such a leader that can delegate authority and build a scalable team that can take the organization forward, and he can evolve with the company. As much as I'm expecting my team members who joined me 3 years ago to evolve with the company as the company grows to different company needs, my shareholders and board expect for me to evolve. I'm the first person to say, if I'm unable to evolve, replace me. But there is a huge price of replacing a founder CEO with a salaried CEO that impacts the vision and strategic goals of the company.
Yeah, I think it's probably a fair point. I don't want to hijack it too much by focusing too much on Tom. But just while we've got you, Eileen, I guess looking the bigger picture here, which is that obviously the founder won't be the day-to-day operational leader as we go through this crisis.
Can I just clarify though, he won't be the day-to-day leader of the UK bank. That's not saying the same that he won't be the day-to-day leader of the company.
Yes.
So I just want to sort of establish that. And just to the points, I think actually the whole idea was to make sure we didn't lose the vision that Tom and his co-founders always had, because so that it wasn't stifled with maybe all of his regulated responsibilities. So this makes sure that we don't lose sight of that vision. This is the kind of idea of the change. But I totally appreciate the point.
I think that the regulatory framework doesn't help, because I think in an ideal scenario, you'd have a chief regulatory officer who would report to the regulators, and the CEO could remain doing, under the UK and European rules, the CEO has to take on the role as basically the chief regulatory officer. So when in banks, so therefore the CEO is very much forced into spending a lot of time with a regulator and less time with product. And so I think it's the construct of a bank sometimes which doesn't help and hinders the founder professional management issue.
But it's the choice of the founder to build a bank in the first place.
Yeah, but I mean, just to add,
that's the point.
When it's a fully regulated bank, where I was a COO of Oak North Bank, that's an SMF 24 role, I'm personally liable. I can face jail. I could face personal, financial liability if I make the wrong decision. That's not the right culture to work within if you want to be a visionary product founder, right? So I completely understand the move there, and I like the way that Eileen has positioned it, because if I personally was an executive at Monzo and I've taken that role, I haven't just taken a role at Monzo, I've taken a role with Tom, and so I would want Tom to still be involved as opposed to another executive. I've decided to work at a startup. I don't want to work for an executive. I want to work for a founder. So I think that positioning is the right positioning. If it was an actual move out, then it would make me question my choice of company. So I think that was really interesting to hear. So on that one.
Yeah, I mean, I think having to deal with regulatory issues is a particular issue that, I mean, as a regulated bank, obviously only a handful of fintechs are having to deal with. I mean, I'll make this a broader question so as not to pick on Eileen. But if you're changing leadership teams in the midst of, I think it's fair to call, a crisis, what are the things that founders and leadership teams need to be doing to ensure that transition isn't disrupted? Because it might, as you say, well be a good thing and a necessary thing to do at this particular moment in time, whatever reason it was that you did it now, I don't know. But obviously it's a disruptive time. So how do you make that as as kind of cohesive as possible?
I feel bad because I don't want to keep being the one to talk about, but I'm happy to give my 2 cents on that. I think that these changes are similar to what founders and executives probably have to think about maybe 1,000 times a day. So I don't know that this particular crisis would be a reason to give somebody pause. I kind of like there's never necessarily a good time to introduce change at a business. And maybe if it wasn't because of COVID, you'd be looking at end of year reporting, or you'd be looking at, I don't know, the beginning of a new quarter, or you'd be 2 weeks away from a product launch, or you'd be 1 week after a bad press report. You know, there's always going to be these challenges that make it never the right time to introduce things that could be perceived in a negative way. And I think the way teams handle that, and the way leadership teams, management teams, and founders handle that, that is what defines them as leaders. And so it's kind of, I guess it'd be the same as what they would do even if it wasn't COVID. You want to make sure that, you know, all the stakeholders are aligned. You want to make sure that, most importantly, you know, the greatest asset of any of these companies, but the people, the team, they understand what the thinking is behind it. You want to be transparent about the reasons for it, which is probably why I spoke at such length about what really precipitated this change. You want to make sure that, you know, you give everybody access in the company to talk to the people that are implementing this change, and that they have the opportunity to ask questions. So it's probably the same as I'm sure any of the founders on the call and anyone that we would talk to would do in any other circumstances, even in sort of normal times.
100% agree with Eileen. I think it's about reassurance to your staff and to your clients. It's about also, above all, clarity on where the vision of where the new leadership is taken, because only if you give clarity can you take the people with you, and both on your customers, but as more importantly, your people. And I think if you have that from the get-go in a new leadership team, then I think that helps enormously. So whether it's COVID or not COVID, you encounter these problems all the time, and it's making a reassurance and clarity are the two things which you have to instill from the beginning.
Yeah, and look, just to add to that, and completely detached from one side, just about leadership in general, it's very rare for all of the founders or all of the executives at C to be doing the same roles at, let's say, Series C. That just doesn't happen. And it's the same with executives that come in. You know, I've come in at Series A at Callsign, and I'm excited about the journey. I don't know if post-exit, 20 years later, I'm still going to be the right person, or even 10 years later. You just have to accept the fact that as a company goes from startup to scale up to basically an incumbent, you might not be the right person to be doing that role. You could still be there doing a different role. We just have to accept there is always going to be leadership change, and that's a natural thing. But hopefully that change is always an upgrade and an evolution, as opposed to kind of departures.
Yeah, I mean, very, very last question before we close off. I think obviously strategic disagreement is always a feature of companies with various executives and various visions. In terms of providing strategic unity about how you handle COVID and how you get out of this crisis, does anyone have, perhaps Amir, you can share as an executive, reflections on how the strategic discussions are happening, and indeed, you know, how the leadership are trying to make sure that there is, at least in the immediate term, an agreement there on how you get through this?
Sure. Yeah, no, happy to. So look, we're a B2B SaaS player that sells generally, primarily to regulated banks. We've also discussed kind of the scrutiny that regulated banks are under. When we were right in the early days of COVID-19, we switched to having daily expos, just kind of a brief half hour. And we had quite a lively discussion on at what point do we switch to full remote working. And the concern wasn't an infrastructure one, because we're a cloud-based service. We don't have any hardware in the office. It's literally desks. So what we were discussing is how do we discuss this with our clients, who are banks, and tell them that our workforce are no longer in one building and they're going to be disparate. And in the end, we made a decision through an open discussion that, well, if anything, this proves our technology. This proves that we are a pure cloud SaaS, and they won't even notice the difference. And so we had that discussion with a number of our bank customers and kind of broached the subject and said, look, we want to move to full remote working before it's mandatory. And they actually said to us, right, you've convinced us, we're going to do the same thing as well. So it was right to be proactive about it. It was right to not wait for something to happen at the government level and make a company decision proactively rather than reactively. And we've continued with that since. So depending on what's happening change-wise, we have a daily morning catch-up on COVID-19. Sometimes it becomes a weekly, but we are, as an exco, constantly talking, how are the teams, anyone worried? This week is National kind of Mental Awareness, Healthcare Awareness Week. So we've been talking a lot about employees, like you've been at home for 10 weeks now, you're going a bit stir crazy. We offer the following things. We have, I think today we've got a meditation session for employees. We're just trying to constantly think about how to keep people connected, but also, to put it bluntly, sane and motivated. And as a management team, it's all about, we're not doing it in isolation, not doing it in email, we're just replicating, sitting in a room and just doing it on a Zoom every morning.
Thank you. All right, I think that's all we have time for, unfortunately.
Sure.
Thank you so much for joining us. I don't know if Devin, you want to close off as the representative.
No, well, I just wanted to say thank you for everyone for participating. I think we're living in, everyone uses the word unprecedented, but this really is an unprecedented time, and I feel that the world of FinTech over the next decade will be shaped a lot by the next few weeks and months. I really do feel that that's going to be, that the next 6 months will challenge us all, and will make us, there will be winners and losers that emerge from this. But I think that the insights hopefully today will certainly be food for thought.
Brilliant. Thank you guys so much.
Thanks for having us.
Cheers.
Thank you for having us. Goodbye.
Thanks.